Good morning, traders, and welcome to the live stream. My name is Charles. I come from a community called Piratetraders, where we are focused on the ES, the NQ, and how they move through the two-way auction process. If this is your first time joining me and you have no idea what you're looking at on the screen, let me just give you a quick 2-minute walkthrough to get everyone up to speed. In the meantime, if you're here, please say hello in the chat, smash that thumbs up button. Those likes really help to pump new viewers to the channel, which is what we're here for. We're here to expand the good word of Bookmap and the auction process. So please smash that thumbs up button. Okay, so as far as what we're looking at here on the chart that you see over here on the left side of my screen, this is a market profile chart. So what this does is it takes the same information that you normally see on candlesticks, which is basically where does price go, and it shows it to you in a three-dimensional way, where you can see where the market spends the most time. That's where you see the most of these little letters, these little clumps of letters. That's where the market spent the most time and where it brought in the most volume. And you can see where it brought in the most volume based on the volume profile bars that are inside the profiles. Or you can look at the bars over here on the left side. That's the cumulative volume, and that'll show you the volume profile. Now, being able to see where the market is, what kind of business it's doing there, whether it's spending a lot of time, bringing in a lot of volume or not, right, helps me to understand what is likely to come next in the market. Okay? It's helped me to understand if the market went to this location and it's bringing in new sellers, it is likely to keep going lower. If it went up to this location and it continues to bring in new buyers, it is likely to keep going higher. So then what I do is I look at Bookmap, which is the chart that you see over here on the right side of the screen. This is an order flow chart where basically this column on the left side of the screen, this is showing us the current order book. So where are their limit longs and shorts sitting in the order book right now? That's not necessarily that helpful in and of itself, because the market does a lot of what's called spoofing, which is where it basically puts fake orders in the order book in order to fool other computers into trading, into taking trades. It's basically computer versus computer, and those computers use the current liquidity as one of the tools that they use for executing trades. So if one computer can come in and throw in a bunch of volume in a certain area, other computers will react to that and start trading towards or away from that volume. Okay? There's an example of it happening as we speak right here, where you see we had this kind of like yellowish, let me change the color of my pen. We had like this little yellowish volume in here, and then out of nowhere, somebody started to pile on a bunch of liquidity right at 55.80. And you can see it got dark red right there at 55.80. Well, that's the market trying to either become a magnet to pull price up to it or trying to scare price away. Okay? So being able to see those changes in real time as they're happening, what is happening to the order flow, what is happening to the liquidity of the market, helps me to understand when things are going to happen. So I might be bullish or bearish because of something I'm seeing on a market profile chart, and then I see something change on the order book, and suddenly I know it's time for me to enter this trade. Now is when the market is going to make that move or not. It's time for me to move my stop if I'm in a trade, because now suddenly the market might reverse or whatever the case may be. Okay. So that is the two charts that you're seeing on the screen right now. For the day today, let's start zooming all the way back out with what Jim Dalton calls the top-down approach. By looking at the market on a larger time frame, it can give us insights as to what might be happening on a lower time frame. So the longest time frame that I will look at is monthly candles. So that means each one of these candles represents an entire month, meaning this period right here is an entire year of time that has gone by. So being able to see what's happening within the auction process over this longer time period helps me to understand what's happening over shorter time periods. For example, on the monthly chart, we had a lot of momentum up. We then started to balance that momentum using time, right? We were trying to spend enough time at higher prices to convince people to go long to keep that momentum going, but we couldn't do it. And we broke out of this monthly balance to the downside. Okay, this month. What does that mean? It means we need a larger pullback with price. It means going sideways at higher prices wasn't enough to get, new buyers to take us to new all-time highs. So we had to put the market on sale. Okay. Now let's go in and let's look and see what's happening on the weekly time frame. Well, on the weekly time frame, we saw that first auction take place. 4 weeks of straight down, right? That was momentum down on the weekly time frame, which was the monthly time frame rolling over and breaking lower, was causing for weeks and weeks and weeks selling to the downside. Well, then what happened? We started to balance on the weekly time frame. We spent the last 2 weeks basically going sideways at the lower end of the range, balancing on the weekly time frame. Okay? So what did that tell us? It told us intraday, the market is probably going to go up and down. It's going to go both sides because we're just in balance. Well, now look what's happening this morning with this week's candle. We're already breaking below last week's candle. Now, I wouldn't say we've broken out of balance on the weekly just yet. If you force me to draw a balance area on the weekly, it would basically be from the lows to the highs. So it would be something that looks like that. So I would say we are still in balance on the weekly, which means we can go up or down on the daily, right? It means we don't have to keep going straight down on the daily because we're in balance on the weekly. So over the next week, we might go up or down. Okay, great. Now let's zoom into the daily. Let's take a look at what's happening there. Okay, well, on the daily, we're getting a more clear picture of what's happening, right? It's a lot more information, so there's a lot more clarity in what's happening. We have these big sell-offs, an attempt to bounce that just causes another big sell-off, an attempt to bounce, which just causes another big sell-off. So this is momentum down. Unquestionably, unarguably, on a monthly time frame, this is momentum down, meaning I do not believe the ES has made its low for the year. I think we're going to go much lower than we currently are. Now, do we have to do that today? We're opening with a big gap down today. There's going to be lots of people that are going to wake up this morning and feel real bearish. So does that mean the market has to go straight down today? No, it does not. Because the weekly time frame is still in balance. We could just turn around and go straight back up from the market open this morning. So let me walk you through a couple of different scenarios, looking at the market profile chart of what today's trade could look like. And pay close attention, because I'm going to give you lots of areas to look for trades and to know when to enter those trades and what you want to see. Okay? So, first and foremost, we have a very large gap to the downside. Often, large gaps don't fill on the first day. Okay? So, the market, when it opens, whenever you have a gap down, the first order of business is always to try to fill that gap for the market. And when I say first order of business, I mean like within the first hour of the day. The market's goal is to try to get up there and fill that gap and get back to yesterday's low, Friday's low. Now, if it can't do that, if the market opens and it starts to push higher and it just can't get up there and it turns around and it starts coming back down, that is what we call a gap and go. The market created a gap and then it just immediately started to go in the direction of that gap. That is the most bearish signal that you can get. There is nothing more bearish than that, than a gap down that is followed by new selling and won't even allow the market to fill the gap. So that is what we call a gap and go. Okay? That to me is the most likely scenario that is going to happen today. If that is going to happen, we will likely get resistance somewhere around the 5580 to 5590 area right in here. So the market will open, it'll push up, it'll try to fill the gap, it'll run out of steam, and it'll come back down. Okay? You could short these levels as a gamble, as a guess that we will get resistance there in reverse, or you could wait for the market to pass back through the opening price after it's gotten the resistance, and you can get short there. Okay? If we get a gap and go this morning, the first major target to the downside is going to be the overnight low at 55.51. Okay? So that's where we think the market, with almost certainty, can get to. If the market opens and we can't fill the gap, I'm 100% sure we will get down to the overnight low. From there, we have to monitor for continuation lower. So it might just poke below that overnight low and then that's it. and then it comes back up. But if we get below that overnight low and we get more new selling, the next target is this large cumulative node right here around 55.30. Okay, that's the next potential level where if the market gets new selling at the overnight low, if it gets new selling at 55.54, we will look for a move down to 55.30. Okay, that's a 25-point move or 24-point move. There's a lot of money to be made in that move. So you could be shorting through the opening price if the market fails to fill the gap, targeting the overnight low. That's a 20-plus point move. And if you get new selling there, you can target a move down to this major support level. That's another 20-plus point move. And then if we get new selling there, I would target a move down towards the weekly lows, which is basically around 5,500. Okay? And again, with new selling at 55.30, you've got a 30-point move to 5,500. So there's lots of opportunities to get short here. You don't have to get short in resistance at the very beginning when the market first opens. You can wait a little bit. You can wait for confirmation that we do have this momentum down because you know what to look for. Passing back through the opening price on a failed gap fill will take you to the overnight low. That's what you're looking for. When you get to the overnight low, you're looking for new selling. You're looking to turn that level into resistance. If you get resistance, you know you got to move down to the next major support. That's what you look for. If you get new selling there, down to 5,500. Okay? Very simple. Mapped it out for you. That's today's trade. Multiple scenarios with 20-plus point moves if you're just patient with your entries. If you just are sure the market is going to keep going down. Now, that's our most likely scenario. Now let's run through the scenarios that are least likely to happen, but still possible. The next one would be the market does fill the gap. It opens this morning and it gets up to yesterday's low. But when it gets there, it gets resistance. There are sellers waiting to smack the market down right at that gap fill. If you get that gap fill and then you get new sellers there, what is the market going to do? It's going to turn around and head back down. That is what we call a gap fill and go. That is very bearish to see. Once again, the target becomes the overnight low. From Friday's low, from 56.17 to 55.54. Okay? Again, plenty of money to be made in a 60-point move. If you can wait for the gap to fill, see the resistance there, and then get into the short. Now, what could happen is the market could fill the gap, come back down. It can't make it to the overnight low, and then we just go sideways inside the range. This, to me, is the second most likely scenario. So first most likely is a gap and go. Second most likely is a gap fill and go that ends up going sideways. The third scenario, which is the least likely in my mind, but absolutely possible today, is that the market will fill the gap and then it won't find sellers at Friday's low. It'll turn out all the sellers were buyers that got squeezed, that got us down here, and there aren't really new sellers waiting at 56.17. If that happens and we start to drift up into Friday's range, to me, the most likely thing is we would then start to balance, right around the lower end of Friday's range. So scenario number one, market tries to fill the gap, can't, gap and go, bearish. Scenario number two, market fills the gap, sells off, but can't keep going, sideways. Third scenario, market fills the gap, gets inside yesterday's range, starts to spend time, starts to bring in volume inside yesterday's range, then probably we're going to get a little bit of a move higher and then sideways up there. Okay. Well, why does this matter? Okay, Charles, you're walking me through all these scenarios. Why do I care? You obviously don't know what the market is going to do when it opens. So how is this helpful to me? Because no one knows what the market is going to do. It opens in 12 minutes, and I tell you, no one knows what the market is going to do. Chairman Powell himself has no clue whether the market is going to go up or down today, because what will make the market go up or down today will be how the market reacts to this gap down. So start to ask yourself the question. You wake up in the morning, you sit down in front of your computer, you see that the market is, 50 points lower than it was at the close on Friday. What do you do as a reaction? Are you instantly shorting? Or would you want to wait for a bounce to get short? Right? So just because there's something bearish to see doesn't mean sellers are going to instantly step in the moment the opening bell rings. So food for thought on that scenario, right? What if you're long the market? You're already long the market. You wake up, you see that the market is 50 points lower and you want to react to that. What are you probably going to do? You're probably going to get out of your long. That might cause some selling, some liquidation, but it won't keep going. So that might get us to the overnight low, but then we reverse and come right back up because the sellers were just longs getting squeezed. So just because the market looks bearish, just because we are opening with a large gap to the downside, doesn't mean the market has to go lower. What matters is how the participants, which includes the bots and the computers, how they react to this move that has happened. And there is absolutely a scenario where the reaction is to push back up into yesterday's low and then go nowhere the rest of the day. Okay? So whilst it is my least likely scenario today, I want to know exactly what that would look like so that I'm not trying to short it and getting squeezed again and again and again, thinking I'm a genius, I see momentum down, and so I got to get short today, and then the market works its way up into yesterday's range and just fucking stops. And none of my shorts all day paid any money. That can happen when you get a gap down. So it's something worth keeping in mind. Any questions on any of that from the chat? Any questions? Good morning to Kiwi. Good to see you. Vu is in the house. Good morning. DNK is here. Welcome, welcome. Jay in the house. Traders, thank God it's Monday. Lots of opportunities ahead for the week. I concur. Will, good morning to you. SC is in the house. He says, Kiwi says, can we take a look at Bitcoin? Yes, we can. Bitcoin. Yeah. Honestly, I feel like I have the exact same thing to say this week that I said last Monday. That's so funny. Yeah, I don't have any clear edge on Bitcoin right now. It's imbalance, and it's been in balance for a couple of months. So, to me, it looks like it needs one more large pullback. So anytime the market is going down, the question I'm always asking myself is, what happens as a result of the market going down? You know, if the market makes a new low where it goes lower than it has previously done in a long time, does it turn around and make a new high? So for example, you know, you had all these lows in here, right? And then it comes in and it makes a new low. So now the question is, was that a big enough discount? Did they make the market cheap enough to bring in buyers to get back above all-time highs? Well, in this particular case, they did. They brought in enough to just get barely above the all-time highs by a couple $1,000. But it worked. It was enough. So then they tried it again. They tried dipping down again, but that was not enough to turn around and get to all-time highs. So they had to come back with a bigger dip down here. Okay? That was not enough to turn around and get them to all-time highs. So they had to dippity dip even further. That was not enough to get them back to all-time highs. So it just makes logical sense that if getting down to whatever 76,000, right? If that wasn't enough to bring in longer-term investors who see it as being on discount and they want to own it, odds are we're going to have to go much lower than that. Okay, we're going to have to go much lower than 76 to bring in those buyers. I think 72 was sort of the level I've been keeping an eye on. Yeah, so 72 is really the upper end of the previous balance, which was a multi-year long balance in here. Okay, so 72 would be a great area to back test, and then that might truly be enough to get back up to all-time highs. If not, if you get below 72, well, then you start risking a move down into the the upper 50s, because when you re-enter an old balance area, there's a very high probability you cross to the opposite end. And obviously we don't want that for the Bitcoin. So 72 to me is sort of the level I'm keeping an eye on. It's a great place for a bounce. It's enough of a dip that we could, turn around and head to all-time highs. But as far as intraday trading between now and when it gets there, can't help you. It's just very choppy. Lots of uncertainty. Momo says 100 points ago was pivotal. Do you mean there was a pivot 100 points above? A pivot point? I'm not sure what you mean by that. Nap is here. Good morning to you. Percy in the house. Welcome, welcome. Trevor is here. Street Salsa. Welcome, welcome. Becca Sem. Sorry if I'm saying that wrong. Good morning to you and welcome. Iphung. He says he's new to Bookmap. Can you explain all the indicators that you are using? I can. It's a lot to take on at once. Okay. So I'll do my best to explain it. There's two different charts that I click back and forth on Bookmap with. Okay. This one right here, which has the stops and icebergs on it. So you can see the stops and icebergs. The stops are the little circles. If it is a green circle, that means those were shorts that got stopped out. If it is a red circle, that is longs that got stopped out. So when you see a little circle and then a number, that is telling you that one account got stopped out for that amount. So obviously when it's 25 or 40 contracts, that doesn't really matter. But when you start to see 100 plus contracts, it should catch your eye because somebody with larger size is getting stopped out. This is a lot of times what can end up causing reversals in the market. So like say the market is going lower and the stops that it's taking out are like 50, 40, 80. And then all of a sudden it takes out like 240 stops. That might be the low. Yeah, you never know for sure. It can always keep going. But if you start to see signs of momentum, you can get long there with your stop below that level because that huge stop out is often the last thing the market is hunting for before it reverses. So the stops can be very helpful in that regard. The icebergs are the little green and red triangles. Again, might be a little hard to see because they're so small, but there are two little triangles on top of each other. That is a sign of an iceberg. So think about an iceberg like you got the ocean here, and then you got part of the iceberg is above the ocean, but then the much bigger part of the iceberg is below the ocean. That's what this is. It is a way for traders to hide their size. So what they do is they just put one contract, limit in the order book. That's it. And then when the market gets there, they automatically, using high frequency computers, they automatically add another and another and another and another, and they just keep piling on more contracts and more at that exact level. But no one can know how many they are going to fill at that particular level. You just know that they're not done. If they start filling those orders and they still have a limit in there, it means they want more. So for example, at the low right now, give me a second. Let me just zoom out here. So at the low, you can see took out a big group of stops, took out 700 stops at the low. That was finally enough to reverse the market and start working its way higher, right? But what do we leave behind? An iceberg. So that tells us that the market knows there's liquidity waiting there. They don't know how many orders are waiting, but they know there's orders waiting there. So it increases the odds that the market will come back. So you can use the stops to see that the momentum is over temporarily. But then when you see that this iceberg is still here, you say to yourself, I'm not going to fall in love with a long trade here because they're probably going to come right back for the low again, right? So that is the stops and icebergs and how I use those. And then I will click over to this screen in the center here. This is basically just filtered through what they call TraderMap Pro. And essentially, if you look at the regular order book, you see all of this right here. this big group of contracts above and below price, they just follow price the whole time. They're just always pegged above and below price. That is to throw off algorithms, to throw off computers. Unfortunately, it also throws us off as order flow traders because it's very hard to see where is the real liquidity. Like, where are the actual orders that are going to fill that are not this BS that's just here to confuse bots, right? So if we look at this through the TraderMap Pro software, it filters out those, what they call market maker bots. Okay. So now we're just seeing real actual nodes of liquidity from real actual traders. Where are they and how are they changing over time? Here is an example of a change in the order book. So they were putting more liquidity above price, trying to pull price up to it. Okay, or scare price away, one or the other. And then what happened? They suddenly started to pull orders. Look at how much thinner it gets all of a sudden right here. Oh, but at the exact same time, they start to pile them on below. And then what does price do? It stops trying to work its way higher and it starts working its way lower. So when you can see those changes, you can see suddenly a bunch of liquidity falls off in one place and suddenly a bunch of liquidity shows up in another, you have, a little edge on what the next move might be. Or at least that there will be a move. You may not even know which direction, but you know something's about to happen because something just changed with the liquidity. It's important to note, in trading, everything is random. There is no guarantees. There is no anything that works every time. So all we are doing as traders is trying to make sense of the randomness. We're trying to find little moments, little opportunities in the day where we have a bit of an edge, where there's a slight chance that the market is going to go in our favor. Okay? I can give you one right now. So what do we say is the first order of business for the market? Always to try to fill the gap, to go up to try to fill the gap. But what did we just do? We just left behind a weak low at the opening price. So that tells us odds are we are not going to get a gap fill, not right away. We're going to get resistance somewhere in this overnight range and then come back through the opening price. So instead of trying to go long to fill the gap, we would watch the market go up and look for the short to come back through the opening price, which is still weak. Okay? These are little edges, little opportunities that the market will give us here and there. And that is what I'm here to share with you. So I'll just tell you guys, I do think this is going to be a choppy morning. I think we may poke down to fill this iceberg down here at the overnight low and then literally turn right back around again. This is feeling like a gap and chop to me, more so than it feels like a real gap and go with real momentum to the downside. So we do have some momentum down, but I don't trust it beyond the overnight low. Also, if you are watching this stream from the Discord, you can jump into the futures /Charles tab and you can ask me questions there. We got Doesman hanging out. Good to see you. Trader is there. Welcome, welcome. Doesman says, it was clear. Thanks. He says, how would Bookmap influence your bias if price reaches a level? Yeah, so the main thing I'm looking for in Bookmap is changes in market behavior. This is what I'm saying, like second by second, out of nowhere, suddenly seeing, oh my God, something just changed. If I'm in a trade, maybe I'm adjusting the trade, right? So let's say, for example, I got long at the opening price, Okay. And the market starts to push up. And then I notice there's an iceberg at the overnight low. I might say to myself, fuck it. I'm not going to get the gap and go. We're coming back for that overnight low. So maybe I just put my stop a tick above my entry, right? To take my risk off the table on my long trade. Or maybe I put a reversal at the opening price. Maybe I get out of my long and into a short at the opening price to grab that move back down. So when will icebergs pop up? I have no idea. But the second that they do, I know it's an important reference. Look, we're getting one right now. I just said, I'm bearish to get to the overnight low, but not necessarily beyond it. Look what happened when we got to the overnight low. Now there's an iceberg above. So now that's telling me that the more likely thing to happen is that we will dip below the overnight low and then turn around and come right back up for that iceberg rather than continue to sell off lower from here. Okay. So what I use it for is second by second, new information that's constantly telling me when things are changing and what I need to be aware of. Speaking of which, we are now at the overnight low. This is a very important moment for the market today. If we are going to get a gap and go, and we're just going to trend down all day today, they will first turn this overnight low into resistance right now. If we don't, it means we are likely coming back up through the opening price and we're going to get a little chop here in the morning. Doesn't mean we can't sell off later on in the day. But if we're going to sell off this morning, now would be the time where those sellers would hold the overnight low. If not, coming back through that open. More chop, more sideways, more grind. Good morning to Dan P. Welcome, welcome. Sheena says, good morning. First thing I do is hit the like button. Well, that makes you an awesome person, Sheena, and I think everyone should follow your lead and smash that like. Let me refresh the page and see how many I got. 32? 32 likes from 129 people? Come on, guys. I told you we were going to the overnight low. I told you we were coming back up through the opening price. Help me out here. It's one little button, one little like. So what else do we notice about that low we just made? Big old stop. 248 contracts. So again, this doesn't mean later on in the day the market can't go lower. But it just means for now that first poke was just to take out those stops. So now we're going to find out, do we get new sellers from here? So any resistance between 55.60 and 55.65 is bearish. If we cross back through the opening price, then we're looking to head up and test the resistance around 55.80s. So can the sellers smack the market down right now? If not, they got to head up into the 55.80s. And this is what we do. We just watch what happens when levels break, do new buyers, do new sellers, step in, and that gives us an idea of what comes next. Alyssa, thank you kindly. MK Tingai. Good morning and welcome. Happy to have you. Douglas says, hi, are the stops shown in real time and the icebergs? Yes. So that stops and iceberg feature is running in real time. And that is what makes it so useful. Because sometimes, for example, let's say we had an iceberg at the low right now, right? Let's just say there was a green iceberg down here, okay? And the market's pushing up. And so we're thinking, oh, it's going to come back down for that iceberg. Well, if the market keeps pushing up and then suddenly that iceberg disappears, guess what? We're not coming back for it anymore. And then the market gets a move higher. So maybe you're afraid to go long. All of a sudden that iceberg disappears. Then you go long and then boop, 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 boop. The market makes its move. So yeah, it's in real time and that's what makes it so helpful. Okay, so this is a really important thing that just happened. We got a look below and fail of the overnight low. So the market poked down there. It took out those stops. It came back up, but then what happened? It got resistance without passing through the opening price. That is very bearish to see. That is a sign that we have new sellers right now at the overnight low. New sellers entering the market this morning after the big gap down. They're not waiting for a gap fill to get short. They're getting short here, which tells us that the market has momentum to the downside. So at this point, I am bearish the market, and I assume it is going lower today. I will stay bearish the market as long as we stay below the opening price. So I'm happy to let them keep kind of poking into here and poking into here as long as it continues to hold as resistance, right? If we come back through the opening price, then everything will change. And instantly I will be bullish for the market to push up to the 55.90 area. Okay. But as long as they stay below the open, this market is likely heading much lower. The next target to the downside is that 55.30 area that we were talking about pre-market. What did we say? If we get to the overnight low and we get new selling, that's the next target to the downside. This is that new selling that's happening here. So it is bearish to see as long as we stay below the opening price. Malik says that algo is so illegal, it's crazy. but laws only apply to certain participants. Yeah, it's one of these things we just got to accept. Spoofing is technically illegal, but it's done by hundreds of institutions all over the world every day, and no one cares. It just is what it is. It's too hard to prosecute, particularly nowadays, because everything is algorithmic. So, like, how do you convict a computer of a crime? You know what I'm saying? If the programmer can say, I just taught the AI to figure out what to do, and it's just doing its thing, and then figure it out if it puts orders in and pulls them and doesn't, you know what I mean? It just gets very complicated. So no one wants to mess with that. No district attorneys want to mess with, fighting some powerful, wealthy institution over some unprovable random thing, so it exists. But like everything else in trading, it can become an edge for you as a retail trader if you just learn to recognize the behavior. Even if all that the behavior tells you is don't take a trade right now because something funky is happening, that's still valuable information. Pavel says the NQ looks more bearish than the ES. Let's take a look at the NQ, see what it's up to. Oh, yeah, you're right. NQ is more bearish. So NQ not only has a gap and go this morning, but they broke the lows of that weekly balance that I was talking about. That is very bearish to see. Okay, so the ES is pushing into that support here around 55.30. We will look for a bounce in here to come back and test the overnight low again. So bounce around 55, let's say 33, for a move back up towards 55.52. If we get a bounce and we get resistance at the overnight low, it's a sign this market wants to continue lower. Okay. If we get a bounce and we push back up through the opening price, then this was probably the low of the day. So that's what we're watching for right now. Do we get the bounce? Meaning the selling is temporarily over. And if it does, how big of a bounce do we get? But really quickly, while we're watching that, I just want to zoom out real quick and take a look at the NQ on the daily and weekly. Yeah. Yeah, boy, that's not good, eh? That's not good at all. So yeah, the Q just broke the weekly balance. That is a breakout of balance to the downside. Of course, it can always reverse back up, and then, it would get bullish by being a rotation up to the opposite end of balance. But for now, as long as this selling continues, it is likely a sign we need a bigger pullback towards the 18,400 area on the Q. Not today, obviously, but in the weeks ahead. That is not bullish, eh? But we'll take it one tick at a time. First, we're looking for a bounce here around 30. Then we're looking for resistance. One tick at a time because we're day traders. Sook just says, smack it. That could be interpreted like you're talking. There could be other things people are thinking you're talking about. Zach says the ticks need to get back to the zero line before the sell-off or no. Yes, the ticks should get back. If we're going to continue to sell off all day today, if it's going to be like a massive trend down day, the ticks will have to get back to the zero first. Maybe that'll be here. Maybe we get a bounce. We get back to the overnight low. That's when the ticks get back to the zero. But the fact that the ticks opened so bearish, so oversold, and we got new selling, there ain't nothing bullish about that. That is a sign that there are new people getting short right now. And they're not getting short because they think the market's going to go up. Nora Auto Trading in the house. Good morning to you. Welcome. Okay. So here's the overnight low. This is the point where we find out, was that sell-off it for the day? That's all we got? Or are they going to keep this momentum going lower for the hours ahead? If they are going to keep the momentum going lower, they must stay below the opening price. They must stay below 55, 65. They got to stay below the opening price. If they pass back through the opening price here, that's likely the low of the day, and we're just going to go sideways and try to fill the gap probably for the rest of the day. So if the sellers want to remain in control, now is where they should come in and smack this market right in the chin. Whoosh. Kiwi says, but my break even is a trap for people who short. I'm not sure what you mean by that. We got 157 people hanging out. Welcome, welcome. If you have any questions, let me know. I'm only here for another 10 minutes. So if you got questions, speak now or forever hold your peace. Also, if you have not hit the thumbs up button yet, always a nice thing to do. Always a nice way to support a streamer. to let them know you care in your heart place. Deep down inside you, you care about them. All right, cue the Jaws theme. Dun dun. Dun 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 dun. This is the last moment for the sellers to remain in control. They want to smack the market down right here, right now, if they want to keep the momentum going to the downside. Dun dun. So we got a question here. He says, if I want to go long now, does Bookmap provide any signal? I would say it's not a good place to go long right now. Once we pass through the opening price, that will change. But I can give you a signal that we were going to come up to the opening price from a few minutes ago, which was that we took out this big order of stops right here, 234 stops from one contract right at, the overnight low, and the market kept going. So like we said, a lot of times when the market's going to reverse, it'll first take out a huge order of stops. So when it took out those 200 stops and it didn't reverse, that told me we need to take out more stops. Okay, so passing back through the opening price changes everything, y'all. It tells us the momentum is over, at least for the time being, to the downside, and the market needs to spend some time doing what we would call going sideways. So technically it will be going up for a little bit, but then we think it's going to run out of steam and come back down. So now I think the market, they tried to take the market lower, couldn't do it. So now they got to push it up to see if there will be sellers at higher prices. So I'm now looking for the market to push up into this area between 55.76 and 55.94 and turn this area into resistance. Okay. If they turn it into resistance and they come back through the opening price to the downside this time, that will be momentum again. And we can start to take the market lower. If they turn it into resistance and they can't come back through the open, then we're probably going to try to fill the gap. So the question in my mind now is, we're not getting the straight up gap and go to hell. We're not going straight down all morning because the look below and fail we just got crossing through the open. So now it is, are we going sideways like this for a while, or are we going to fill the gap? So I'm watching what happens in the resistance here to tell me that. To tell me, are we going to fill the gap or are we going to come back down? Let's see what happens. So somebody said to me, okay, how do I get long if I want to get long now? Well, now that you've crossed through the opening price, it is acceptable to get long. So the question you need to ask yourself is, what support are you willing to buy? You know there's a pretty good chance they'll come back down to the area around the overnight low where we've got all this liquidity. So would you rather go long right now and use a wider stop? Okay, because you got to use a wider stop if you're going long right now. Or would you rather wait for the market to dip down into this area around the halfback here, and then you go long in there with a tight stop, right? Like, which would you rather do? And it's a matter of personal taste. If you're going to go long up here with a wider stop, you're going to have to trade with much smaller position size. Whereas if you wait for the dip and you buy support, now that it's confirmed that the market wants to go up, if you buy support from here, you can trade with larger size because you can trade with a tighter stop. The difference in the two is the first one, you're guaranteed you're going to get in because you're just getting in right now. The other one is you're waiting for a dip you may not get. You may not get that chance. It might not come back down and fill your order, and it turns around and heads up without you. And that's what being a trader is balancing these decisions all day. First, I'm waiting to see, do we still have momentum down? I definitely don't want to be going long if there's a chance we've still got momentum down. Now that I know we don't, now that I know we're going sideways, where do I want to get long? Do I want to get long in a place where I risk missing the trade, but I take on less risk in it? Or do I want to take on more risk in the trade, but be guaranteed to enter? And that's what you're playing in your mind all day, every day. That's what you're writing down in your journal and you're keeping track of. Today, I just instantly went long the moment we passed the opening price. These are my results. Tomorrow, I'll wait for the pullback and I'll buy the dip. And then I'll check out those results. And I'll track the difference between them. Which one do I feel more comfortable executing? Which one gave me the better results? Right? If you start to track that information over time, the way you choose to enter trades, which trades are the easiest for you to execute, where you feel the least amount of pain, and which trades work out with the best results on paper. And you just adjust those two towards each other, right? To where you get more and more comfortable doing the things that work better. And that's what trading is. That's what getting better as a trader is all about. I teach all of this in my workshop, Mastery of Markets in Mind. We got one coming up in like 6 weeks. If you're thinking about joining, why not start by just joining the brigade? That's $20 a month. You can see there's a link at the top of the video here, piratetraders.io/join. You pay $20 and you get access to these live streams every single morning with me. I will give you my analysis, my breakdown of the scenarios for the day, and I will walk you through, as long as I'm sitting in front of the computer, I will walk you through what's happening step by step. So I'm not trying to brag here. I'm not trying to toot my own horn or anything like that. I'm just trying to give you a context. Go back to the first 5 minutes of this live stream and replay what I said. I said the most likely scenario was that the market would go lower today. If we got below the overnight low, we would get to this node here. Now, we didn't quite make it. We missed it by a few points, but that's okay. I don't have a crystal ball. I can't always nail everything to a tick perfectly. But the idea was once we got below there, and again, you can go back and watch the first 5 minutes of the day. I said this. If we came back up and didn't turn the overnight low into resistance, we would push back into the upper end of the overnight range. So I mapped all this out 30 minutes before the market even opened. That's why I've been so good with my calls this morning. That's why every time I've said, maybe this is where it reverses, maybe this is where that, and it keeps happening at exactly those times and exactly those places. It's because I planned it all out ahead of time so that as I'm watching the market move throughout the day today, all I need to say is it doing what I expected or not? And then that tells me how right or wrong I might be, which of my scenarios is playing out. So now we're pushing up into this area where I'm looking for resistance in the overnight range. And I'm saying to myself, what happens? Because I know if we get resistance here, one of two things is going to happen. Okay. We're either going to come back down through the opening price and the selling will continue into the C and D and E periods, or we'll come back down, find support, and then just basically go sideways. One of those two things is going to happen if this resistance holds. Okay. If this resistance doesn't hold and we poke through, guess what we're doing? We're filling the gap. Okay. So because I figured all that out pre-market before the market opens, now all I need to ask myself is, where is the market and are we getting resistance? And that makes being a trader so much easier. Having a plan ahead of time, understanding how markets work, understanding what levels things change and what those changes look like when you see them in real time, it's so much easier to follow along with what's happening in real time. I do this every single day for $20 a month. So you could have made $20 is half a point on the ES of profits. One contract, half a point. So there have been opportunities this morning to make more than that from the opening price to the overnight low. Okay? There's opportunities right now to make that with a move up into resistance. The brigade membership will absolutely pay for itself. So if you are looking for some more insights, you might consider signing up. Thank you guys very, very much for joining me. I appreciate it. That is it for me today. Head on over to Bruce's live stream if you are not a member of the brigade. If you are a member of the brigade, let us set sail on the ocean of profits. I will see you over there in about 3 minutes. Thanks a lot, everyone. Have a great day, and we'll see you here next week. I'm talking about